What if I told you that the most important part of stock analysis takes under 1 minute, but it's the one that most investors skip entirely? It took me over a decade of professional investing to figure this out. Over 25 years of professional investing, I put together what I call the Pulse framework, tying together 5 fundamental signals from all 3 financial statements to quickly tell which stocks are worth my attention. Let's define the Pulse framework and why it's so useful for our analysis. So first, we're going to talk about the P, which is economic profits. So you might be wondering, why use economic profits instead of return on invested capital? Isn't ROIC a better metric? Well, it's not really. Think about it this way. Would you rather have 20% return on capital or 15% return on capital, right? That was actually an interview question I got asked 25 years ago when interviewing for my Fidelity Equity Research position. Well, the answer is it depends. And depends on what? On how much capital can be invested. The economic profits. So this is this chart in the upper left, and it's looking pretty good. You can see the economic profits, at least over the last decades, are positive, which is important, and rising, which is even better. And 7% free cash flow yield for a company that's been growing double digits cycle to cycle, that's interesting. It's not off the hook cheap, but it is interesting.